Hey, I'm Ben from Modern Graham, and today I'm going to give you a Modern Graham valuation of Albemarle Corp. So be sure to stick around to hear what I think of this company. So we have Albemarle Corp, and I'll be honest, I'm not sure that I'm saying that right, but it is what I'm saying. But anyway, the ticker is ALB. The price is 202.24. The sector is basic materials, and the industry is chemicals. And here we have the items from the balance sheet that I find most important. We have total current assets, total current liabilities, long-term debt, total assets, intangible assets, total liabilities, and outstanding shares. And all of these figures will come into play in the valuation. Now over here we have a handy chart that shows the earnings per share diluted in blue and the dividends per share in red over the last 30 years. And you can see that the earnings have gone up for the most part, and then there's been a giant jump the last few years, which is going to play into the valuation a little bit. But I mean, it will have a pretty big impact on that, but it will be a little bit muted. And I'll tell you why right now. Looking at earnings over here, we have the details. And I have two figures for earnings here. We have earnings per share diluted, which is what you find on the income statement. And then we have EPS MG, that is earnings per share Modern Graham. And that is a weighted average of the last 5 years of earnings, with the most weight on the current year and the least weight 5 years ago. And so what we see with that is that kind of smooths out the business cycle a bit, so that years like now that we have a giant jump, it isn't quite as extreme, and we've had 2 straight years of that. So it has been up for 2 years, and it is showing more of that now than it did last year. But that growth may not be the same as what you would see. And so maybe it comes down in a few years, and that would be balanced out a little bit more on the weighted earnings. And over here, we have the dividend history. Going back for 30 years, you can see that they have consistently paid a dividend. And not only that, but they have consistently grown their dividend, which is really good to see. The dividend yield right now is very low for this company. Normally, it is between 1 and 2%. And the last couple of years, it has been below 1%. And they've been a bit hesitant to grow that dividend despite the giant earnings. And that would say to me that they are anticipating those earnings coming back down a bit. The dividend payout ratio, you can see, is a measly like 7% right now. I don't know why this is showing. Oh, 2021. Yeah, look at that. The earnings were only 106, but the dividends were 156. So that really spiked. I was getting confused because I forgot that this estimated year doesn't line up. So yeah, anyway, that you can see that they put a high priority on their dividend and growing that dividend. So you can expect consistency in that dividend going forward from this company, because even on years when their earnings dip, they're still growing that dividend. Stage 1 of the analysis. Is this company suitable for the defensive investor or the enterprising investor? And remember, the defensive investor is one who is not willing to go into depth in their research into a company, so they have very stringent baseline requirements. So let's take a look here. The first test is market cap, and they have to be greater than 2 billion. They pass that. Next, they have to have a current ratio over 2. They are very close at 1.9, but that's not 2, so it fails that test. Earnings stability has to have positive earnings for 10 years. It passes that. Dividends for 10 years, we know it passes that. And increase in earnings at least by 33% in 10 years, and it passes that. The PEMG, the price to earnings figure using that weighted average, needs to be below 20, and here it is 13.57. The price to book has to be below 2.5, which it's not here, but there is an alternative way of getting that, and that we're getting this test passed, and that is price to book times the price to earnings ratio has to be less than 50. And here, when you take 13.57 times 2.57, you get 34.94, which is less than that 50, so it passes that. And if you've been keeping count, we are at 6 out of 7, which is enough for the defensive investor. Now, the enterprising investor is one who is willing to do more research, and here By default, they would be suitable for the enterprising investor because they are suitable for the defensive investor. But let's take a look at the tests anyway. Current ratio has to be over 1.5 for the enterprising investor. Here it is 1.9. Debt to net current assets have to be under 1.1. Here it is 1.03, so we pass. Earnings stability, positive earnings for 5 years, passes that. Currently pays a dividend, yep, it passes that. And earnings per share greater than 5 years ago, it passes that. So perfect score for enterprising investors. Now, if you are liking this video, please take a moment to hit that like button, subscribe to the channel, and download the free valuation calculator. A link is down below in the pinned comments and in the description, and that will help you do valuations like this on your own. Stage 2 is a determination of the intrinsic value. Remember, the value is different from the price. The price is what the market is currently willing to pay. The value is what the company is worth. And to calculate that, we use the modern Graham value formula, which is taken from Benjamin Graham's book, The Intelligent Investor. And his formula was value equals earnings per share times 8.5 plus 2 times the growth rate. I've modified that slightly by using the normalized weighted average earnings. So that is the EPS MG again. And so that is the modern Graham value formula. And so we've got two variables to calculate here. Let's get to it. Earnings per share, again, is a 5-year weighted average, putting the most weight on the current year and the least on 5 years ago. So we get 1491. Plug that in here, and we take the figure from 5 years ago. Calculate a total growth of 237% over those 5 years, divided by 5, and that is an average growth of 47%. Now, we have two spots here where we have safety margins kicking in, because you don't want to overestimate growth, because that will have a huge impact on your valuation of the company. And so, first of all, we have a safety margin of 0.75 of what that average growth calculation is. And then I also have a cap of 15% on the growth estimate, because it does not make sense that any company would grow greater than that in perpetuity. And this is a perpetuity valuation formula. And so that growth rate, I cap at 15%. This is the maximum value that this company could have at this time. And plugging those calculations or those variables into the formula, we get a value of 573.91. Now, with this very handy chart here, you can see that the value is way higher than the current price. And for details, you can see down in this corner in the bottom left, Modern Graham opinion, the current price is 202.24, and that is only 35% of its intrinsic value, so it gets the undervalued rating here. A few other things to look at. First of all, the Modern Graham value based on 3% growth. If you put 3% growth in here, you get a value of 216.15. And if you put a 0% growth in, you get a 126.74. That also, if you put the price, the market price in for value and solve for growth, you find that the market is implying a growth rate of 2.5% about. Now, if you think the company will grow more than that, then that would be an indication that the company is undervalued. If you think it will grow less than that, it would be an indication that the company is overvalued. And so that is another way of looking at this formula. Coming down to the Modern Graham grade, this is a system that is intended to bring in more factors than just the valuation, so that if you are an investor who likes to follow the Warren Buffett rule of I'd rather invest in a great company at a good price than a good company at a great price, then this is where you can look at it, where like how you can kind of figure that out and get a grade that you might be able to compare to other companies so that you can figure out what might be a good opportunity. Here it gets 2 points for investor suitability, 1 point for being a good price to value, 1 point for trading below its Graham number, which we'll talk about more in a moment, 1 point for long-term dividend growth. It does not have a solid dividend yield right now, so it doesn't get a point there. It is trading below its industry average PEMG, so it gets half a point there. And for a total score of 5.5, which is an A+ grade in the Modern Graham grade system. Stage 3 is further research. So at this point, if you've determined the company is suitable for your investor type, stage 1, and you've determined that you believe the company is undervalued, stage 2, then it's time for you to do further research to determine if the company is suitable for your individual portfolio, taking into consideration your diversification needs and other parts or like other things in this analysis, like the net current asset value. Now, this doesn't actually apply here, but this is useful information on other companies because it can provide a floor for your value. And that is because it is a liquidation value. If a company takes all of the current assets and pays off every single liability, that net current asset value is what cash is left to distribute to shareholders without even taking into consideration the other assets that are not so liquid, like land and things like that. And so right here, we have negative. So it doesn't really apply here, but I always want people to keep in mind the net current asset value because it is a key figure that people should pay attention to. Then we have the Graham number formula. This is derived from those defensive investor requirements, and it is a way of putting a number to them so that you can compare it more quickly. Here we get a Graham number of 203.35, which is very, very close to that current price of 202.24. And so technically right now it is trading below that Graham number, but it could easily fluctuate up and down among or like around that Graham number right now. So that's one thing to keep in mind. And again, the price to earnings ratio with the weighted earnings is 13.57. Current ratio is 1.9. PB ratio is 2.57. Dividend yield is 0.79%. And it has 29 years of consecutive dividend growth. So that is very good. Here's some figures about share buybacks. It has been negative buybacks, which I think means that it has been issuing stock, but it has been issuing less stock lately than it did 10 years ago. So that is interesting to note. And there have been 3 insider buys in the past 3 months. Now, moving on to stage 4, it is time to do a tiny bit of technical analysis. Now, I know what a lot of value investors think and fundamental analysts think, that you shouldn't pay attention to technical analysis. But my view is that this is where it can come in handy. You never want to use it to determine the value of a company, but it can be useful in trying to time your entry point. Once you have decided that a company is undervalued using fundamental analysis, then you can move on to technical analysis. And looking at the chart here, I have it set up the way I like to set it up on tradingview.com, which if you want to find a charting platform, you can follow the link down below. It is an affiliate link. I would really appreciate that if you signed up using that. But anyway, it's a good platform for charting and stuff like that. And so you can see that we've been down lately. We're on the daily view right now, but we are on the way back up. And I think right now would not be a good entry point based on my analysis. And the way that I'm looking at this, I want to see, like right now, we are on the way up because we're above that red line, which is the moving average of the price, and we're just crossing over the blue line, which is the medium-term moving average, which is a good sign, and it could be on the way up. But I think you might want to be a little bit cautious because looking at the relative strength index, we are on the way up, and maybe, I mean, this, I think it might consolidate at some point, is what I'm trying to say, is that we're on the way up, and you can see before it has gone up and it comes up and then it consolidates and then it came back down. So that would be one thing to watch. But also these lines, the red and blue, are moving averages of the relative strength index that I'm following. And here you can see that it is that it's pretty low there. So there is a lot of room for that to go up, I think. And looking down here, this is the Bollinger Band width. And that can just be a little bit useful too. It isn't all that useful for this one because it doesn't fluctuate all that much. It does a little bit here, and then you can see that it tightened a bit here very briefly, and then there was more downward pressure because that moving average was really high on that relative strength index. So that's why I would think that it would go down there. It tightened again about here, and there was a little bit more upward pressure, and it started to go back up. But that isn't too useful at this particular time because it is kind of stable where it's at right now. But this relative strength index is more interesting to me, and I think that immediate term, it has gone up a lot in the last week. I would think it would stabilize a bit before continuing to rise a little bit more. But that is one thing to watch. And yeah, so I hope all of this is useful to you. Be sure to click on the video on the screen now for another valuation that I think you will find interesting. Thanks for watching, and I will catch you next time. Take care.